Hi, I'm Ashley Osborne. I'm the CEO and co-founder of Deval Global, the digital platform that helps people make better real estate purchasing decisions. Today, I wanted to talk about the London property market. Now, if you read the press and you listen to people on the street, everybody's forecasting a property crash. The world's going to end, the economy's going to end, property prices in the UK are going to come off by 30 or 40%. People are going to be living on the street. It's going to be a bloodbath. Now, we don't disagree that the UK economy is in for tough times ahead. The UK property market is also in for tough times, and we think some of those markets, like the northeast and north of England, have been overinflated, and definitely there's going to be some significant correction there. But we actually think the opposite might happen in London. We think that the London property market, there's a significant amount of opportunity for the investors that can see it. And in fact, we think there's about 9,483 opportunities in London that investors and buyers should be considering. And we wanted to explain them to you today. So here we go. Why do we think that there's 9,483 reasons why London might be a buy in 2023? Well, first, I think it's important to look at the market because everybody talks about house price growth in the UK or England or other countries as if it's a single thing, right? In the UK or England specifically, what we had was two periods of growth over the last 6.5 years. So the period immediately after Brexit in June 2016 till June 2020, we had no growth. So we had growth of about 9.75% over a 4-year period. So average house price growth of about 2.2%, slightly above inflation. For the period after July 2020, we had huge growth in the average price of a property in England. And the reason for that is simple. Firstly, we had a stamp duty holiday. So there was an incentive for people to buy property because they were saving taxes when they purchased a property. And secondly, we had a huge amount of people leave large cities and go to some of the secondary cities because they thought there was an opportunity for them to work from home forever. It was much cheaper to live outside of London. So there was a bit of an exodus in London and people left. And consequently, that really drove house price growth because at the same time, we had very, very low interest rates, some of the lowest that the UK's ever had. And in that 2.5-year period between July 2020 and essentially now, but really August 2022, we had 25.3% average house price growth over a 2.5-year period. That's huge. But I think what people have got to put in perspective is that house price growth wasn't even. It's not as if England, all house prices grew from the sort of south to the north at exactly the same pace. What actually happened was completely opposite to what normally happens. So places like the southwest, but also places in the north, like Yorkshire and East Midlands. I'm Australian. East Midlands to me is north. And the northwest grew at really, really high levels. So more than 30%. At the other side, London grew very slowly. So there was about 16% house price growth in the London market over that period of time. Okay, it's above average in terms of growth, but nowhere near the same sort of explosive growth that we saw in other parts of England. If you put that into context with what happened in the rest of the London market from, say, that June period, it tells a very different story. What happened between June 2020 and June 2022 is essentially we had moderate price growth. So 18% over a 6-year period, which works out to be about 3% on average per year. So that's not crazy house price growth like we've seen elsewhere. London house price growth has been relatively stagnant. Part of the reason is Brexit, but also the pricing got to a certain point that it became very expensive and the market just naturally slowed. The bit that a lot of people don't talk about is housing supply. Now, people talk about the need for new housing in London and the England and the UK, but nobody really nails down to actually the numbers and what they actually look like. And I think that's really important. So if we look at London specifically, in terms of demand And it depends on whose study you look at. There's one that's been done by the London Mayor, and there's a couple of other ones out there. But essentially, demand expectation is somewhere between 66 and 72,000 new homes every year required just to meet existing demand. Okay, so there's huge demand just as we stand. The problem is supply has fallen off significantly, and Brexit has been a real cause of that. So new planning applications in London, it takes between 2 and 4 years to get planning, have really significantly dropped off. So they've gone from sort of 40,000-ish in 2016 down to below 25,000 at about 20,000. And new construction starts, it takes about 18 months to 24 months to deliver something, have also come off by north of 25,000 down to below 20,000. So supply is really contracting, and it's been contracting for a long time. These are not just new phenomenons because of the housing market. It's because of the way that the London market works. And it's very different to other parts of the UK. And I want to explain why. First, that housing supply slowed much earlier because of the price mechanisms in the market. But the other thing is, it's much more difficult to deliver new housing in London than other parts of the economy because it's a different type of housing. So in London, we have relatively medium to high density housing, I think you would call it, relative to what happens in the rest of the UK, which is essentially houses, semi-detached and detached, built in fields by house builders like Persimmon, Barratt's, Taylor Wimpey, Redrow, etc. It's got a very different supply profile. So houses in fields, very easy to supply, very easy to get up and running with projects, also very easy to stop. You essentially sell a house as you build one. It doesn't work that way with high density housing. It's very, very difficult to stop once you've started. There's only really 2 times that you can stop a development, and even still, it creates lots of pressure and problems. The first is once you've poured your foundations. So you buy a parcel of land, you get your consent to build a development on it, and you get to the point that you've poured your foundations and you say, the market's not really strong enough for us to sell these apartments, so we'll stop or slow down the site. And the other point is when a developer gets to what they call roof. So the walls have been built, the windows are in, the doors are in, first fix is done, and the roof is on, and they've essentially got a watertight structure. It's also possible for them to delay delivery as well by just essentially not going as quickly with the construction. But they still create a lot of problems because they still have a finance cost, which is eating away at their profits. And also it's very difficult to delay contractors and the different people involved with delivering these developments. So it's not a sort of zero-sum game. There's a cost to doing this. The other thing as well that's really interesting in that market particularly is there's a much higher requirement for pre-sales. So most developers need somewhere between 30 and 50% of a development sold before they really get into meaningful construction, because they can't create what they call stock apartments. And what stock apartments are is essentially housing which has been built and completed but not sold, because that requires sales and marketing teams to run the developments, marketing suites to be open, advertising spend. And the other thing is, because you could be selling something and you haven't sold it, it means your finance clock is ticking too, so it's eroding your profit. So what that really means is, for new supply to start in the future, not only will developers need to sell their existing supply, but they'll also need to see significant demand and actually pre-sales going before they start new projects. The other thing as well is, obviously in London, is that time for planning. So even if developers say today, well, the market's really coming back at pace, we need to start supplying because we can see a demand for people to purchase them, so we'll build to demand. There's still that gearing up. They still need to buy the land. They still need to get planning. They need to tender the construction work, and they need to place the construction contracts. That's a 2 or 3 year process for most developments. That just by itself means that even if developers said today, I want to start a new supply, it's unlikely that that supply will come online till, maybe 2026, maybe 2027. There's a huge supply problem in the London market. The other side of the equation is rents. Rents aren't interesting if you're an owner-occupier, but they are if you're an investor. Obviously, London has some of the highest rents in the country. The rent in England from a median basis is about £800 a month. The median rent in the inner London market is more than double that at £1,700 a month, and about £1,350 in outer London. So rents are very high in London, and everybody talks about the how high rents are. But the reality is rents are growing fast, but they don't show any signs of coming off, because what happened was we've had two things. One, as people come back to London, as this work from home unwinds, I'm not saying people aren't going to work from home for a period of time, but it's really unlikely people will be working from home 5 days a week now. There's demand because people are coming back to London. The other thing as well is Section 24. So Section 24 was introduced by the government in 2017. What it effectively does is reduces the amount of mortgage interest that a landlord can offset against their costs, and therefore reduces their profits. It was introduced on a sliding scale, so 25%, 50%, 75%, and then 100%. So what that meant was a lot of landlords that thought, do you know what, this is not for me anymore because I can't make as much profit as I once could, sold their properties. So they sold in 2020, 21, and 22. And it means that there's a lot less rental supply. So rents are starting to go up, and there's no reason for them to slow down because there's just a lack of supply. Everybody that we speak to in the rental market, and we work with a number of partners across the London market, says the same thing, which is essentially every time we advertise an apartment on the market on one of the portals, we have exactly the same scenario. There are at least 20 applicants for every property that we market. Now, I get the argument that somebody's going to say, but there's only so high rents can go. Yes, that's true, but we're not even close to that yet, because what I think people have got to put into perspective is, yes, there are 20 applicants and there's a certain amount of them who can't afford rents at higher levels, but it only requires one person to rent an apartment. So yes, as prices go up, there'll be less and less applicants, and it might be 10 or 5 or whatever. But the case is, most landlords only need one tenant, and there's quite a lot of growth, I think, in rents in London, particularly when you compare London to other capital cities around the world. So I don't think people should just expect that rents will taper off or they're going to hit some natural ceiling at any time soon. Now, let's get on to the opportunities. So we said there were 9,483 opportunities, and we think there are, and this is why. Because the market works in the housing market in two halves. So you've got the secondary market, which is the largest market. So that's the market where people own homes and they would sell them through an estate agent because they were either upsizing or whatever, for whatever reason. We think there won't be much stress in that market. We think the reality is things are going to get tough. The economy is going to be in a tough space. Pricing is going to come off. But the reality is most people in London are going to say, I own property in one of the most expensive real estate markets on the planet. It's going to be very difficult for me to buy again in the future. If I can hold on, I may as well hold on. Inflation is eroding my mortgage debt. And if things get really tough, what I'll do is I'll switch from from principal and interest to interest only. And that will alleviate a huge amount of pressure. So we just don't see there being a very active secondary market in London over the next 2, maybe even 3 or 4 years. It's different for developers. Developers aren't normal sellers. They make stuff to sell, and they are apartments and houses. Like Apple makes computers to sell and Toyota makes cars to sell. Developers make housing to sell. They have to sell them so they can recognize profit. And developers are going to be under a lot of pressure. So in London itself, there's 9,483 apartments that complete this year that are currently unsold. There's going to be a really soft market in London this year. There's not going to be many buyers, and it's going to be a really tough situation. Those apartments are concentrated into 320 developments. And of those 320 developments, 58 of them haven't even launched yet, and 28 of them are part sold. There is an argument that some of them might be sold to build to rent investors, and some of them will. But in terms of the ones that could be sold that haven't already been sold, we think there's only 9. And the reason for that is simple. Because build to rent or institutional investors, or whatever you want to call them, buy a very specific type of property. They buy properties which have they own the entire building, so they have to get that. They need to own the freehold as well, so that does create some complications for certain sites. And they typically want at least 100 apartments in a development. There's actually only 9 that meet that requirement. There's one other requirement which is also holding funds back, which is that there are new laws coming into England which mean that most large high-rise buildings will require 2 fire escapes as part of the new fire regulations. Very few developments have them in London at the moment. So some of those 9 developments might suit build to rent, but that lack of fire escapes is going to be a major problem for these funds. And these funds are very specific about what they buy. So we think that these opportunities are going to be significant because developers are going to have to sell these. They're going to have to discount them to meet the market. They won't want to own stock apartments. And so they are going to move as quickly as they can to try and sell them. We're going to have the same problem in 2024, but not to the same extent because developers have got more time to deal with issues, slow down delivery, etc. But these 9,483 opportunities could be significant for first-time buyers, for owner-occupiers looking to upsize or move to London, and for investors. There's going to be a lot of opportunity, and developers are going to have to discount heavily to get a buyer. And we think this is where the opportunity is going to be in London and in the UK property market in the next 12 or 18 months. Just to sort of tie all of this together, it's how this why we think this is so important is really that supply is going to be a major issue for London, right? London's a global city. It's not going to change. People will always want to work and live in London. People are going to return to London as the economy deteriorates. They're going to be close to the job. They won't want to be made redundant. They will want to be seen to be active. Landlords, people talk about the exodus of landlords, but the reality is Section 24 has been in place since 2017. So most landlords that have a lot of exposure to Section 24 have sold. The other thing as well is there's going to be huge pressure on capital values and rents in the future. So once we get through this temporary blip in the London market and the UK economy, the supply issue hasn't gone away. And if anything, it's got a lot worse over the last few years. And finally, opportunity is driven by 2 sides of the market. Just because there's developers or investors that want to buy at a discount or owner-occupiers that want to buy at a discount, it doesn't mean that everybody on the other side of the equation has to sell it or is forced to sell. The only group that's absolutely forced to sell in that space is developers. So we think people should keep an eye on this. We're happy to share our research and our knowledge with people. Follow us on social media and we can explain to you why we think this is a big opportunity. In terms of how we can help you, we've built our own property platform designed to help people make better real estate purchasing decisions. Come and visit us at devalglobal.com and follow us on social media as we talk more and more about what's going on in the UK and property markets around the world. Thank you very much. I hope you enjoyed it.